You're watching the Market Comment at xm.com by Mario Sechigiriakos for Thursday, September 21st. I'm Crispina Marujas. The Federal Reserve kept interest rates unchanged yesterday as widely expected, but revised its economic forecasts and interest rate projections higher. The updated dot plot telegraphed one more rate increase for this year, and FOMC officials now see interest rates closing 2024 at 5.1%. Hence, the Fed now predicts only 2 rate cuts for next year from 4 cuts previously. Overall, the Fed delivered rosy economic forecasts and lifted its rate path to reflect the notion that interest rates will remain at higher levels for a longer period of time in order to cool the U.S. economy. Investors responded by pushing out the anticipated timing of the first Fed rate cut, which is now expected in 1 year. This translated into a boost for U.S. Treasury yields, with the yield on 10-year debt rising higher to trade at its highest levels in 16 years. With the Fed's rate path getting recalibrated higher and long-dated U.S. yields hitting new cycle highs, the natural beneficiary was the U.S. dollar, which reached its strongest levels in 11 months against the low-yielding Japanese yen. The dollar currently offers a unique combination of solid economic fundamentals, high interest rates, and safe haven qualities. In contrast, other major currencies, such as the euro, are haunted by faltering economic growth, rising fuel costs, and high exposure to slowing Chinese demand. This economic divergence might be increasingly reflected in FX rates moving forward. Meanwhile, Wall Street lost ground on Wednesday as the prospect of elevated interest rates for a prolonged period of time is harmful for riskier assets like stocks. Similarly, gold got rejected near $1,947 yesterday and fell sharply after the Fed decision. That said, bullion continues to display relative resilience. It remains 7% away from record highs, even though U.S. yields have reached their highest levels in a generation, so it seems there's real demand from inelastic buyers, most likely central banks raising the gold reserves. As for today, the central bank torch will pass to the Bank of England. Following the latest inflation report that was colder than expected, markets are pricing this rate decision almost as a 50-50 coin toss. As for the pound, the risks seem tilted to the downside. Even if the Bank of England raises rates, the vote will probably be split, and the bank is unlikely to commit to further action. Hence, any upside FX reaction on a hike might be short-lived, and if the Bank of England does not raise rates, the pound could fall immediately. Thank you for watching today's Market Comment here at xm.com.